Yeah, I think in a normal historical world, people would start to be looking at value. They'd start to be looking at these cyclically sensitive areas and the small caps as well. We're not in a normal period. This is a world where what's mattering most is margin and low leverage here. We still have quite high rates. We still have inflation in certain areas, in some certain big pockets, which is quite strong still. And we have this uncertain path about how growth is going. Earnings expectations, if we think about it, are quite high if we expect that the reason for the rate cutting cycle is that we're starting to see a slowdown in growth, and that probably the Fed is going to message a continued slowdown in growth, and that this is really about the soft landing. So if we're still expecting this soft landing and earnings expectations are already quite bulled up, I think what you want to continue with and really focus on is margins, low leverage, margin expectations, not just the trailing margin, and who can defend that in this period in a world where rates are still high and labor costs are actually still quite high.
So Dan, I mean, boy, let's hope those bulled up. Yeah, but Dan, listen, let's hope those bulled up earnings expectations actually manage to deliver, right? Because the other thing that could potentially keep the market up or push even higher is multiple expansion, although I wonder whether or not that's going to happen. And I ask this question because if the Fed does not cut, does 25, right, does not cut 50, what's the reaction of the bond market going to be? It's rallied big time since July, right? If yields back up, what's it going to do to a market which is trading at 21 times?
You're exactly on the right path here. And that's what I'm thinking, is that the expectations are way ahead of the Fed. Again, we keep seeing this. I think the course of the Fed is going to be, we'll get 2 or 3 cuts this year. They're probably going to signal another 5 next year. We'll get 8, something like that total in the expectation. The market's expecting more than that. And the 10-year has already come in quite a bit. This is likely the bottoming of the 10-year yield. So this is where it gets really tricky, that if we expect this difficulty in having that pass through into the curve, these rate cuts really affecting the longer end more, then it doesn't solve a lot of the problems. We get a steepening yield curve, we get more term premium, and that isn't the best medicine for convincing businesses and consumers who are already stretched in certain pockets to take on more debt, make more credit, and to because that hurdle rate remains quite high. So that's exactly the right issue. The bond market probably is ahead of itself, and I think that's really why we see institutional investors not really going into the bond market very much. We see them still, maintaining high equity positions. They're going into the short end still. They're buying cash, year or less duration, but with spreads really tight in the credit space, this uncertainty ahead. It makes sense why they're not going to pile into bonds going forward. That risk is there.